Hello everyone, welcome to the latest TM Brunsdon market update. I hope that you're all keeping safe and well as we look to ease out of lockdown. I'm pleased to have with me again Mark Shields, investment manager from Brooks Macdonald, who will be answering a few topical questions. Welcome, Mark.
Hi, Brian.
Mark, markets have been holding up rather well of late, and I'd just like to run through a few questions our clients are asking at this moment in time. First one is centered around inflation. Inflation has been talked about quite a lot of late. Is a rise in inflation likely to be a risk to the positive market movements of late?
Yes, I think this is the latest sort of area which investors are focusing on as a potential negative impact for markets in general. There are concerns that the degree of stimulus that we are seeing from Western economies may well drive an inflationary environment, and that has a knock-on effect onto bonds. Typically, they perform badly in higher inflationary environment, and indeed potentially onto equities as well, because often equities are valued against bonds, and essentially a higher inflationary environment can mean that but both equities and bonds could potentially suffer, given the strong performance that we have seen particularly from equities over the past a few months, really. So this is a concern. It's one that we are watching quite closely, but actually our base case is that we feel that the concerns over inflation are probably a little bit overdone. The Federal Reserve in the US has been quite adamant about the fact that it is well aware of this as a risk, and it is unlikely to make a policy error such as a taper tantrum that we saw a few years ago, where essentially they took the markets by surprise and looked to raise rates quicker than the market was expected. So they've actually acknowledged that as a risk that they are very keen to avoid. So they've already stated that. We've also seen that the pressure from inflation coming through into the system, especially in the US, actually remains relatively constrained versus historical ranges. But also, probably the most important one of all is that we saw one of the biggest drivers of inflation is actually wage growth. And in the US in particular, whilst we did see an uptick in wage growth post the lifting of the first lockdown in the US last year, we've actually begun to see that moderate. So that means that our base case for inflation becoming entrenched is not as, or at least our view is that it's not going to be as likely as maybe the market is being concerned about. We might see a short-term inflationary spike, but we think the chances of that causing a policy error of some description are relatively low. So it's something we're keeping an eye on, but we don't necessarily think it's a real cause for alarm at this point in time.
Okay, understood. Let's turn to the UK, Mark. With Brexit implications starting to work their way through the system, is the UK market looking more compelling?
Yeah, I think it is beginning to look a little bit more compelling. Obviously, certainly within the Adventurous Fund, we've been underweight the UK for quite some time due to various reasons, mostly political in nature, and obviously we've started to see some of those concerns begin to diminish a little bit, especially with regards to the Brexit situation. Although I would point out that there will be further negotiations, especially surrounding the deal between the UK and the EU when it comes to the service industry. We've also seen some other positives with the UK, but much more recently, the biggest one being the very positive vaccine rollout within the UK. So at the moment, the UK has managed to vaccinate nearly 27% of its population, which is way ahead of any other large economy. The next nearest large economy is the US at around about 18%, but the EU average is less than 6%. So in terms of large economies, the UK has done exceptionally well. when it comes to the vaccination program. Obviously, there are some smaller countries like Israel that are even further ahead, but obviously they're not really comparable in terms of size. But preliminary data from Israel seems to suggest that a vaccination program is very effective at reducing the rate of hospitalizations from COVID-19. So this is all quite positive stuff for the UK. If the vaccination program is successful and is rolled out as quickly as it has been, then clearly we can get the economy open back up again, and that would only be positive for the UK markets as well. In addition, we've seen valuations in the UK are very depressed compared to their global peers. Companies in the UK are relatively cheap, and equally, the UK has been ignored by global managers when it comes to allocating assets. And we've seen a slight uptick in terms of those global managers who are more willing to look at the UK when it comes to allocating some of those assets. And these are all positives for the UK. Having said all of that, we still think it's possibly a little bit early to increase our exposure to the UK at this point in time. We feel that the UK has a very large number of sectors that are unloved and will possibly remain unloved in the immediate future. And there's also some further political issues on the horizon, not least to do with a potential referendum in Scotland, which we may well see over the summer. So we still feel there are risks associated with the UK, but the picture is looking rosier. Let me put it that way. And the investment, the investment argument for the UK is becoming stronger, and I would expect us to potentially increase our allocation to the UK again at some point this year.
Okay, sounds positive. There's been a mini retail investment boom of late. Is this likely to raise any concerns up ahead for you, Mark?
There has been, yeah. So I mean, there's been certainly a few incidences of retail investment sprees hitting the headlines. GameStop is probably the most reported on one, but there's been a few other shares that have been driven higher by a surge of retail money. Nokia is a very famous one that also has been impacted by this. It is a concern in that I think it potentially does show where we are in the market cycle, and we probably are more towards the end of the market cycle than the beginning. And that's something that we need to be aware of, but we don't think we're at the end of the market cycle yet. But in terms of the actual portfolios that we run, we feel that there's very limited impact indeed. We don't have any exposure to any of the hedge funds that are shorting these sort of companies. We don't really have any exposure to that sort of market at all. So our exposure to this sort of action that we have seen is very limited indeed. I suspect it's a bit of a flash in the pan. And I think that despite the exuberance that we're seeing from the retail space, I expect this to begin to, it'll start to diminish over time as we sort of become back into sort of more normal market conditions, as it were.
Okay, Mark. Thank you very much for that, and I'd like to thank you also very much for watching. As always, if you have any questions, then please be in touch. Thank you.